Hello viewers, you're welcome once more to my YouTube page. If you're joining me for the first time, you're welcome. Don't forget to like, subscribe, and interact with my pages to get updates. So we shall take a look at a topic in management science under management accounting, which is called a topic called marginal and absorption costing technique. So let's take a look at the question together. A company has the following data in relation to her product. We have the materials and the cost per unit. So we have my direct materials to be 3 naira, direct labor to be 4 naira, variable overhead to be 1 naira. So the total is 8 naira. The fixed cost is 4 naira. That makes it 12 naira. So in the additional information, we were told that the budgeted level of activity is 200,000 units, selling and administrative cost 100,000 naira, selling price per unit is 16 naira. The data relating to production and sales units in 4 years are as follows. So we have the year 1, year 2, year 3, and year 4. So we have the opening stock, the production, the sales, and the closing stock, and we have the data for each of the years. So, as management accountant, you are required to present the results of operations for the relevant years in the absorption costing technique and marginal costing technique basis on the assumption that the cost structure of the company remains unaltered. So, just follow me on how I'm going to go in solving this question step by step. So in the step 1 is that you should know that the marginal cost is devoid of fixed cost element, while the absorption cost has an element of fixed cost in it. So the step 1 is that I need to calculate the information that will be needed for both the marginal costing technique and the absorption costing technique. Remember, I said that the marginal cost is devoid of fixed cost. That is the only thing I need for the marginal cost is just the variable cost. This is what I need. It is devoid of fixed cost. Why? For the absorption cost, it has an element of fixed cost in it. So here are my workings. So my total variable cost shall be 8 naira, because it is already given in the question. All the direct elements, which are the direct material, direct labor, and variable overhead, this is 8 naira. So my total variable cost is 8 naira. Remember, when solving for the marginal cost, the only thing I need are the variable cost element, which is 8 naira. After that, we need to solve for the sales. And in the question, we were told that the selling price per unit is 16 naira and the budgeted level of activity is 200,000 units. So for us to arrive at the sales, that is so this working is for the marginal cost. So for us to get the sales, that will be activity level times the selling price per unit. So that will be 200,000 units times selling price 16 naira. So we make use of your calculator. You shall be getting 3,200,000. So we can now solve for each of the years proper. So for year 1, the opening stock is what is not given. So I'm going to write a 0. So for the production variable cost, that should be, remember my variable cost is 8 naira. So my production variable cost shall be 8 naira times the production for year 1 is 200,000. So that should be 1,600,000. The next is for the sales variable cost. For the sales, we had already calculated it here. Then the closing stock. Remember, there's nothing for the closing stock for the year 1, so that will be 0. Nothing. So the next thing is to go to the year 2. For my year 2, my sales shall be, so for the year 2, the sales shall be, remember, for year 2, our focus is year 2, and the sales here is 180,000. And remember, our sales unit is 180,000, and the selling price per unit is 16 naira. So to get a total sales unit in value, that will be 180,000 times 16 naira. Then that should give us, using my calculator, that should be 2,880,000. Then for the production variable cost, remember our variable cost is 8 naira. Our variable cost is 8 naira. Then go to year 2. what is the production unit? 240. So that will be 8 naira times 240 units. That should give us 1,920,000. After the production, which else is yet to be captured? So we have the closing variable cost. The closing variable cost, that will be variable cost times the closing stock. Remember, this is year 2. Our closing stock is 60,000 units. So that will be 8,000 times 60,000. So that should be 480,000. That should be 480,000. So the next one is the year 3. For year 3, my sales shall be 16,000, which is selling price per unit times the sales unit, which is 220. Year 3, my sales unit is 220. So that will be selling price per unit 16,000 times 220,000. So that should be 520,000. After the sales, we have the opening stock. The opening stock, remember we are making use of your variable elements. That'll be 8 naira times the opening stock unit, which is 180,000. That gives us, so after the opening stock, we have the sales. We've already sold for the sales. We have the closing stock. That will be the variable cost, which is 8 naira times the closing stock unit, which is 20,000. So here 3, everything is complete. The opening stock, the production. Okay, we are yet to capture the production. So the production is 180,000. So the production shall, remember we're making use of the variable element. That will be 8 naira times the production in units is 180,000. So I shall use the calculator to evaluate this. Remember, I have opening stock, production, sales, and closing stock for the year 3. Everything is complete. For year 2, remember the closing stock is missing. If you go to the year 2 calculation, that is why we don't have the opening stock there. So the opening stock, let me just write it so that when you are going through it, you will understand why it is 0 for year 2. It is 0 for year 2 because when you go to the table for year 2, the opening stock is nothing, like it is empty. So it is equivalent to 0. So that is all for the year 3. So I would love to recap how I'm going about this. So remember that in the table we have opening stock, production, sales, and closing stock. So for year 1, the opening stock is 0 because there's nothing given. Production, the production variable cost shall be 8 naira, which is the variable cost per unit, times 200,000, which is the production unit. You get this. Then the sales variable cost shall be 200,000 times, this shouldn't be 16. This should be since it's variable cost, that should be sales times 8 naira. This is 8 naira. This should be 8 naira. So I shall correct it later. So that should be 1,600,000. Please kindly take correction. Then for the closing stock, it is nothing, so it is automatically 0. Good. Then for year 2, we shall also do the same. The production variable cost shall be 8 naira times the unit. The closing stock shall be 8 naira times 60. The opening stock for year 2 is not given. That is why we're having 0. Then the sales variable cost shall be, since the sales for year 2 is 180, that should be 180,000 times 8 naira. Remember, it is variable cost. You should have an element of variable cost in it. So that should be 8 naira. So I shall use my calculator. Let's do the calculation already. Right. Once and for all. So we have 180 times 8. That's 1. So this should be 1440000. So you do the same for year 3, then year 4. So for the absorption costing, we shall be making use of both the variable and the fixed cost elements. Remember, I said that your marginal costing is devoid of fixed cost. The only thing we need for the marginal costing is your variable element, which is this 8 naira. But when we are solving for the absorption costing element, we are going to make use of this 12 naira. No, we are not going to use this 8 naira. So we are using both the elements of variable and fixed cost. So since our total fixed cost is 12 naira, so for year 1, we shall repeat what we did when solving for the marginal cost. Okay, let's do the year 1 together. So at least you can do the year 2, year 3, and year 4 on your own. But I'll definitely do the video here. You'll see it. Okay, year 1 now. We have the opening stock. Opening stock. That shall be 12 naira times. So for my year 1 now, remember there is no value for the opening stock for year 1. That will be 0. So it's the same thing as 0. Then we have your production. Your production. For your production, that will be 12 naira times the production unit, which is 200,000. The next item in the table is sales. For your sales, that will be 12 naira times the unit sales for your one, that's 200,000. Then the closing stock. The closing stock for the year is empty, so it is the same thing as 0. So you are going to do the same thing in year 2, year 3, and year 4. Just that when I'm doing the year 3, for the year 2, 3, 4, I'm going to speed it up due to time factor. So I just want to bring to our notice that irrespective of what you are solving, be it marginal or absorption costing, when you are solving for the years for the from year 1 to year 4, the 16 selling price per unit, the 16 which is the selling price per unit, is what you are going to use throughout. Please kindly take note. Kindly take note of the correction. You can see for year 1, under the marginal costing calculation for year 1, please make use of the selling price per unit, which is 16 naira. Year 2, year 3, then year 4, 16 naira. Then even for the absorption costing, we are still going to make it of the sales. So it means that if the sales value for both the marginal and the absorption cost technique shall be the same, irrespective of the technique. So this is the here is the year 2 for the absorption costing calculation, 16 naira per unit, 7 price per unit. Year 3, 16 naira. Year 4, 16 naira. Kindly take note of these corrections. Thank you. So the next thing shall be to create a table of this nature. You create a table. We have the operation on marginal costing technique and operation on absorption costing technique. So let me zoom and explain how we are going to go about it. So you can see we have your particulars, then the places for the year 1, 2, 3, and year 4, and they are in thousands. So we have my particulars. Under my particulars, I have, so this table is more of like it's like a trading account, like your trading profit and loss account, remember. So it's synonymous to it. So we have your sales, opening stock, production, closing stock, your contribution margin, your fixed cost, selling and administration, then your net profit. So for year 1, you go to your calculations for year 1. So which is the year 1 calculation. We have the sales. The sales for year 1 is 3,200, which we have here. The opening stock is 0. That's why we have dash here. Your production is 1,000. That's 1.6 million. That's why we have this. Remember, the values here in thousands. Then your closing stock is missing. It's 0. That's why we have this dash here. Your fixed cost. We get your fixed cost, which is 800,000. Remember, in the question, we were given that the fixed cost is 4 naira. And the budgeted level of activity is 200,000 units. So that is how we arrive at the fixed cost value. That is fixed cost times the budgeted activity level, which is 4 naira times 200,000, which is 800,000. So that's how this 800 is derived at. In the selling and administration, it is given in the question. It was stated that selling and administrative cost is 100,000 naira. So this is where the 100,000 is coming from. So for year one, we have our sales 3,200. Then the opening stock is not given. The production is given, which is 1,600. So we have the opening stock plus production plus closing stock. We have this. Or opening stock plus production less closing stock. Less closing stock, because in year two, closing stock is given. That's why it is in the bracket. So we have your opening stock plus production less your closing stock. You get this value. So you deduct this value from your sales. You have 1,600, which is a contribution margin. Then for your fixed cost, you have 800,000. Then selling and administration cost is 100 naira. So you less it. So 100 minus 800 minus 100, that's 700. So 1,600 minus 700, that'll be 900. So you do the same thing for your year 2, year 3, and year 4. Remember, this is the marginal costing technique. So you go to where you want your workings for year 2, year 3, and year 4 to impute their values. Then for the absorption costing, we are going to do the same thing too. But in this case, remember, we are going to do the same thing. So marginal value for the marginal table, the absorption values for the absorption table. So the essence of we computing this is to derive at our net profit and to know which of the technique the company should adopt based on the data that is available. Now, in the operation on marginal costing technique, remember this is our net profit. The highest here is 1,060. For the absorption costing technique, the highest is 780. So from the look of things, it is this technique that has the higher net profit. So it is advisable for the company to adopt the marginal costing technique based on the information that is available. Thank you guys for staying tuned. Don't forget to subscribe to get updates about my courses. So in my playlist, I already have my videos are already arranged. I have the ones for English, I have the one of mathematics, I have the one for management science courses, and do it yourself hacks. So see you guys in the next video.